Hey everyone, my name is Aman, I'm 22 and I'm a student of finance. And in this video, I will show you that if I had to invest 10,000 in mutual fund every month, how would I pick funds and how much would I invest in each? So let's get started. So what is a mutual fund? A mutual fund is essentially a pool of money that is used to buy variety of stocks. So for example, if you don't understand stock market or you want a diversified portfolio, so you would want to invest in the top 50 companies in India. So if one doesn't perform, the other companies still do. Now, if you had just 10,000 rupees, you won't be able to buy all of these 50 companies, that too in the right ratio. So what a mutual fund does is it collects 1,000 from you, 5,000 from somebody else. Like this, it collects from thousands of people and then invests that whole sum of money into different companies. Now that we know what mutual funds are, we will talk about the two main types of mutual funds. The first being active mutual funds. In this type of a fund, a team of professional investors with a lot of research pick good companies. And the objective of such a fund is to beat the relevant benchmark. So for example, if this is an actively managed large cap fund, then the goal of that fund will be to beat the Nifty 50 index. Nifty 50 is just a collection of the top 50 companies in India. If it is a small cap actively managed fund, then the goal of that fund will be to beat the Nifty small cap 250 index. Now these type of actively managed mutual funds tend to have a lot of high commissions for all the research and to give you better than index returns. Now the second type of fund is passive mutual fund. This type of a fund essentially just matches the index. So for example, if this is a passively managed large cap fund, also called an index fund, they will take your money and put it in Nifty 50 as it is. As the goal of this type of fund is not to outperform the index, but to simply just match it. And this type of a fund, the fund manager doesn't require a lot of knowledge, brain power, effort, research, nothing. So the fees tend to be minimal. Now we'll talk about some of the terms that you might come across while investing in mutual funds. The first is ETF. ETFs are nothing but just passive mutual funds that trade on stock exchanges. The second is thematic or sectoral. So these are based on themes. So for example, banking could be a theme. So if you're bullish on banks, then you can invest in a banking fund, or it could be an IT or energy fund. The third is small cap, mid cap, and large cap. So these are funds that invest on basis of the market cap of a company. A market cap is nothing but just the total value of the company. So if it is a small cap fund, then the companies that it will have will be smaller and riskier. If it is a mid cap fund, then it will be medium size, medium risk companies. And if it is a large cap fund, then big companies with lower risk. Now that we've discussed the two types of mutual funds, I will show you how I would invest 10,000 every month. Now the mix of investments is different for everyone. For example, if you prefer lower risk, or you are not in your early 20s, or your horizon is not 30 to 40 years, then you will learn from this video, but you will have to make little tweaks in your investment portfolio to match your situation. Now, if you are in your 20s and you don't have people dependent on you, then at least 50 to 60% of your portfolio should be in high risk, high reward types of funds, because this is given your emergency fund is sorted. This is because being in your early 20s, you have the gift of time. That gift of time will help you ride out many crashes, many corrections in the market. So this is gonna be our split: 3,000 in Nifty 50, 3,000 in small cap, and 4,000 in micro cap. Now, as for Nifty 50, I would opt for an index fund, also known as passively managed fund. This is because time and time again, it has been proven that about 85 to 90% of actively managed funds underperform even the index. Now, these might have overperformed in the past couple of years, but in general, in the long term, they tend to underperform. So let's do a case study here. If you were to invest 3,000 in Nifty 50, Nifty 50 has a 20-year CAGR of around 15%. This means that in a span of 20 years, it has given a 15% return on average every year. Let's say you retire at 60. So the tenure is 40 years. You will have made almost 9.5 crores. Now let's say that this was an active fund that unfortunately underperformed by just 1% year on year. and it also charges a commission of 1%. So your return has gone from 15% to 13%, and this would result in you earning 4.5 crores, less than what you could have.
So now let's pick a Nifty 50 index fund. You can screen mutual funds yourself on ticker tape. So we check on index under equity, and these are the funds ranked based on their AUM. AUM is asset under management, which means the total amount that they have invested from people like you and me. And a large AUM can indicate that it is generally a trusted fund. So the one on top is UTI, and the expense ratio here is 0.17. This is pretty low. And if you are looking for a fund with an even lower expense ratio, you can sort it by the expense and then look for a big name. It has to be Nifty 50 though. So as you can see, Nippon has 0.07 expense ratio. It doesn't really matter much if it is just a difference of 0.1, 0.15. You can pick the one that you like. Let's pick Nippon India Index Fund Nifty 50 plan just for the low expense ratio. Now, Nippon being a big name, AUM should not be much of a concern. You are free to pick any good index fund as long as the expense is close to 0.2.
Next, we come to small cap funds. Now, for small cap, I prefer an active fund despite the high expense ratio. Why? Because if the economy was to do well, Nifty 50 will perform. But this is not always the same case with small caps. There are times when small caps are overvalued. And in that case, even if the market was to perform, you see a muted growth in small caps. But if the market was to fall, then small caps would fall like twice or thrice as much. So for this reason, I believe you require experts, people who can pick good decent stocks according to how market is. And for that reason, we will look for a good actively managed small cap fund.
Now the index here has given a 5-year CAGR of 26.4%. So we look for a fund with a relatively small expense ratio and a return not necessarily too high, but just over 26.4. This is because according to odds, no mutual fund can consistently beat the index every single year. Now let's set the expense ratio to low. We can see that Tata Small Cap Fund has given a great performance, and the expense ratio is also well below 1%, so it's good, and it's an old and trusted company. We can pick this as our small cap fund. Now the last fund we want is a microcap fund. As of now, as per my knowledge, there is only one fund that has exposure to only microcaps, and the fund is called Motilal Oswal Nifty Microcap 250 Index Fund. This is an index fund, so nobody is managing it, and it has a diverse portfolio of 250 microcap stocks. And this fund has been recently started, but the fund house has been long in the game. It is well respected, very old, and microcap funds, being the most risky, also have the potential to deliver most exceptional returns, because small cap 250 or microcap 250, they tend to have a higher beta. What this means is if Nifty was to go up 1%, these would go up 1.5 to 2%, and the same if the Nifty goes down, these go down even more than Nifty 50. So if you look at Nifty 50's chart since inception, it has always gone up in the long run. There are phases when it corrects or even crashes, like the 2008 crisis or COVID-19. But when you give it time, it always ends up making new highs. Now, if you are a believer that India's future is bright and that Nifty will keep making new highs, then from investments like these, where the beta is high, the long run, these will generate you very good returns. Let's say you are able to create a portfolio like this. The goal is to create a portfolio where there are safe instruments like the Nifty 50 index along with some risky instruments. Let's imagine if we are disciplined in our investments and are able to generate 20% CAGR year on year on a span of 40 years with 10,000 rupees of investment. How much can it grow up to? It goes up to 170 crores. Now let's adjust it to inflation. Let's be pessimistic. Let's say it's 8%. It will be worth 12 crores of today's money, which means it could buy stuff worth 12 crores today. Now this was based on my opinion. This might not reflect what might be right for you. So don't just go and invest just because I mentioned some funds. Keep this video as a reference when you are studying mutual funds yourself. And if you learned something new, do press the like button so more people can find this video. Thank you.